Jewish families preserve wealth for 100 years or more. Christian families lose 70% by the second generation, 90% by the third. The difference is not luck, it is not intelligence, it is a three-number code. 33, 33, 33. King Solomon encoded it in Ecclesiastes. Jewish law codified it in the Talmud. This allocation system has survived every economic collapse in 3,000 years. You have been told to diversify. Your financial advisor says, spread your money across stocks and bonds. You obey. You believe you are protected. You are not. Jewish law sees your stocks and your bonds and your savings account as the same category. You have 90% of your wealth in one bucket. You are one market crash away from losing everything your grandchildren will never inherit. The ancient Hebrews divided wealth into three distinct buckets: land, business, liquid, each exactly 1/3 of total wealth, not 40-40-20, not 30-50-20, exactly 33-33-33. This is not modern portfolio theory, this is biblical allocation law. It protected Jewish families through Babylonian exile, Roman destruction, the Great Depression, 2008, and every crisis between. You are about to learn what each bucket protects, why the ratio must be exactly 33%, and how to rebalance your current allocation over the next 5 years without destroying your net worth in the process. At the end, a prayer for wisdom to allocate your wealth biblically awaits you. Your financial advisor says, diversify. But what does that mean? Diversify into how many categories, what percentage in each? They never tell you specific numbers. Some say 60-40 stocks to bonds. Others say 70-30. Others say it depends on your age or your risk tolerance. This is guessing, not systematic allocation. Most of you watching this have 85 to 95% of your net worth in what financial advisors call your portfolio, your 401k, your IRA, your brokerage account, your emergency fund. You own stocks, you own bonds, you own mutual funds. You believe this is diversification. When 2008 came, your diversified portfolio lost 40 to 60%. When 2020 came, it crashed 30% in 30 days. You were told you were protected. You were not. The problem is not that you failed to diversify. The problem is that no one taught you the biblical standard for allocation until today. Modern finance gives you vague advice. Buy a mix of stocks and bonds. Rebalance once a year. Hope it works. Ancient biblical law gives you exact numbers. 3 buckets, 33% in each. No guessing, no hoping. Here is the biblical standard Jewish families have used for 3,000 years. The ancient Hebrews called it the rule of thirds. Jewish families today still maintain it. 3 buckets, equal portions, no exceptions. Land, business, liquid, not 40% land, 40% business, 20% liquid, not 30-50-20, exactly 33-33-33, 1/3 in each category. This is not flexible. This is not negotiable. This is the biblical standard. Why 3 buckets, not 2 or 4? 2 buckets create instability. When one crashes, you lose 50%. 4 or 5 buckets dilute focus. You cannot manage that many well. 3 is the biblical number of completeness. Father, Son, Holy Spirit, past, present, future, land, business, liquid. When King Solomon built the wealthiest kingdom in history, he maintained this allocation. Land, vineyards, olive groves, fields across Israel, business, trade routes to Ophir, merchant fleets sailing to Tarshish, mining operations extracting gold and copper, liquid, 1 Kings chapter 10 verse 14 says Solomon received 666 talents of gold annually, about 25 tons of gold per year, stored in the treasury. The Talmud formalized this interpretation of Ecclesiastes chapter 11. Jewish communities in Babylon, Spain, Poland, and America maintained the 33-33-33, split through every persecution and economic collapse. Their wealth survived. Christian families who abandoned this biblical framework lost 70% by the second generation. Now let me show you what each bucket protects, and why you must maintain exactly 1/3 in each. The land bucket includes anything fixed to the earth that you own directly. Real estate, farmland, vineyards, timberland, mineral rights, anything that cannot be moved, cannot be printed by a government, and has been valuable since Abraham bought the cave of Machpelah in Genesis chapter 23. Land cannot be inflated away. When governments print currency, your cash loses purchasing power, your stocks lose value, but land, actual physical earth, remains. A vineyard that produced 1,000 gallons of wine in Solomon's time produces 1,000 gallons today. The value is intrinsic. In 1920s Germany, hyperinflation destroyed the currency. A loaf of bread cost 200 billion marks. Those who held paper money, stocks, bonds, cash, were wiped out. Those who owned land, farms, buildings, survived. The land did not inflate. The land remained. Today, your land bucket includes residential real estate. Rental properties, your primary home, but only if it represents 33% or less of your net worth. Farmland, commercial property, real estate investment trusts, but only partially, because rates are also traded like stocks. Here is the common mistake. Your house does not count as diversification if it is 60% of your net worth. That is concentration in land, not balance. The goal is exactly 1/3, not 40%, not 25%, exactly 33%. If land exceeds 33%, you are over-concentrated, vulnerable to real estate crashes. If land is below 33%, you lack inflation protection. Leviticus chapter 25 verse 23 says, "The land must not be sold permanently, because the land is mine." Land is a generational asset. It passes from father to son to grandson. That is why it must be exactly 1/3 of your allocation. Land preserves purchasing power, but it does not generate income. That is the function of the second bucket. The business bucket includes equity ownership in operating companies that produce goods or services, not stocks, not shares in mutual funds. Actual ownership in businesses that generate cash flow. Business adapts to the economy. When inflation rises, businesses raise prices. When technology changes, businesses pivot. When consumers demand new products, businesses create them. Land sits static. Liquid waits passive. Business produces income. King Solomon operated merchant fleets. 1 Kings chapter 9 verses 26 through 28 say, Solomon built ships at Ezion-Geber, near Elath on the shore of the Red Sea. His fleet sailed to Ophir and brought back 420 talents of gold. These were not investments. These were operating businesses Solomon owned that generated annual cash flow of 666 talents of gold, about 25 tons of gold per year. In the Great Depression, stocks crashed 89%. Bonds defaulted, but grocery stores, repair shops, farms, operating businesses continued producing income. Reduced income, yes, but not zero. The families who owned businesses survived. Those who owned only stock certificates did not. Today, your business bucket includes ownership in your own company if you are an entrepreneur. Silent partnership in local operating businesses. restaurants, repair shops, medical practices, private equity in non-public companies, crowdfunding platforms like Mainvest or Republic that let you invest in small businesses, royalty streams from intellectual property. Here is what does not count. Stocks do not count. When you buy Apple stock, you do not own Apple's business. You own a liquid paper claim that can be sold in seconds. That is the liquid bucket, not the business bucket. Proverbs chapter 31 verse 16 says, "She considers a field and buys it. Out of her earnings she plants a vineyard. Business income funds land purchases. The two buckets work together, but both must remain at exactly 1/3. Too much business equity creates concentration risk. If the business fails, you lose everything. Too little means you lack income generation. Exactly 1/3 balances risk and income. Land preserves. Business generates. The third bucket captures opportunities. Where are you watching from right now? Drop your location in the comments. I want to see where this ancient wisdom is reaching today. The liquid bucket includes anything that can be converted to cash within 30 days. Cash itself, savings accounts, money market funds, stocks, bonds, certificates of deposit, anything that trades on an exchange or can be withdrawn quickly. Liquid assets capture opportunities. When the Great Depression crashed real estate prices by 50% and stock prices by 89%, those with cash bought land and businesses at 10 to 20 cents on the dollar. 10 years later, those assets were worth 10 times what they paid. Liquid is not for safety. Liquid is for offense. 1 Kings chapter 10 verse 14 says Solomon received 666 talents of gold annually. He did not spend it all. He stored it. Why? Because when famine came, or war threatened, or opportunity appeared, liquid gold could move instantly. Land cannot move. Business takes time to sell. Liquid deploys in days. Benjamin Graham, the father of value investing, had a rule. Maintain 25 to 50% cash during bull markets so you can buy during crashes. He did not call it biblical, but he discovered what Solomon knew 3,000 years earlier. Warren Buffett follows the same principle. Berkshire Hathaway held $147 billion in cash in 2022, waiting for the next crisis to buy bargains. Your liquid bucket includes cash in savings, money market funds, short-term bonds under 2 years to maturity, stocks. Yes, stocks are liquid, not business equity. Long-term bonds, gold and silver bullion that can be sold quickly. Here is the common mistake most Christians make, if this is making sense to you. Like this video right now. It tells the algorithm to spread this ancient wisdom further. Most Christians have 90 to 95% in the liquid bucket. Your 401k, IRA, savings, emergency fund, all liquid. You think this is safe. It is not safe. It is concentrated. When markets crash, you have no land generating rent and no business generating cash flow to survive on. You are forced to sell liquid at the bottom to pay bills. That is how 70% of wealth disappears by generation 2. Too much liquid earns low returns. Cash loses to inflation. Too little liquid means you cannot buy during crashes. Exactly 1/3 gives you dry powder without diluting your returns. Now you understand the 3 buckets. But where does the Bible command 33, 33, 33? Here is the answer. Ecclesiastes chapter 11 verse 2 says, "Ship your grain across the sea. After many days you may receive a return. Invest in 7 ventures, yes, in 8. For you do not know what disaster may come upon the land." Most people read this as poetry about being generous or trusting God with your money. It is not poetry, it is allocation mathematics. Let me show you what Solomon encoded. Ship your grain across the sea. That is business, trade, commerce, merchant operations. After many days you may receive a return. That is time horizon, long-term generational wealth building, not day trading. For you do not know what disaster may come upon the land. That is risk protection. When disaster strikes one category, the others preserve your family. Invest in 7 ventures, yes, in 8. That is subdivision within each bucket. Do not put all 33% of your land bucket into one rental property. Divide it into 2 or 3 properties. Do not put all 33% of your business bucket into one company. Divide it into 2 or 3 businesses. The total is 7 to 8 positions across all 3 buckets. The Talmud formalized this 1,500 years ago. Jewish law says divide your wealth into 3 portions. 1/3 in land, real estate, 1/3 in business merchant operations, 1/3 in liquid, reserves held in hand. Then within each portion, divide again into multiple positions. This is not my interpretation. This is Jewish legal tradition spanning 100 generations. Why do Christians miss this? You were taught Ecclesiastes. 11 is about charity or faith. Jewish children are taught it is about allocation. That is why Jewish families preserve wealth for 100 years. And Christian families lose 70% by generation 2, same Bible, different reading. Notice the verse says 7 ventures, yes, in 8. Solomon is commanding subdivision within categories, not diversification across the same category. Most Christians miss this distinction. Now here is what most people miss when they apply this verse. You believe you have followed this biblical command. You own stocks in 12 different companies. You own bonds from 5 different issuers. You own 3 mutual funds. You count that as 7 to 8 ventures. You believe you are biblically diversified, but Jewish law asks a different question. It does not ask, how many different stocks do you own? It asks, how many different categories do you own? There is a distinction, and that distinction is what preserves wealth through every economic collapse. Before I show you the distinction, you need to understand that recognizing this will be uncomfortable. It will require you to admit that what you believed was diversification was not. It will require rebalancing. It will feel risky. But 3,000 years of Jewish family wealth says the risk is in staying where you are. Here is the distinction that changes everything. You own stocks in 12 companies, bonds from 5 issuers, 3 mutual funds. You count that as diversification across 7 to 8 ventures like Ecclesiastes commands. Here is what Jewish law reveals you believe. I own stocks and bonds and a savings account, 3 different things. Therefore, I am diversified across 3 categories. Jewish law asks, what function does each asset serve? Your stocks can be sold within seconds for cash. Your bonds can be sold within seconds for cash. Your savings account is cash. All 3 serve the same function. Liquid assets convertible to currency in under 30 days. Jewish law counts all 3 as one category, the liquid bucket. This is not diversification across categories. This is subdivision within one category. You have not obeyed Ecclesiastes 11:2. You have misread it. Right now, pause this video if you can. Add up every dollar you have in your 401k, your IRA, your brokerage account, your savings account, your checking account, your emergency fund, your bonds, your CDs. That total is your liquid bucket. For most of you, that number is 85 to 95% of your total net worth. Now add up the equity in your home, any rental properties you own, any farmland. That is your land bucket. For most of you, that is 5 to 15%. Now add up your ownership stake in operating businesses that generate cash flow, not stocks. Actual businesses you own or are a partner in. For most of you, that number is 0%. You do not have 33, 33, 33. You have 90% liquid, 10% land, 0% business. You are in violation of 3,000 years of biblical allocation law. Not because you are foolish, because no one taught you to read Ecclesiastes 11 the way Jewish families read it. Until today. Here is why this matters. When the next market crash comes, and it will come because Ecclesiastes 11:2 says, "You do not know what disaster may come." Your 90% liquid will drop 40 to 60%. You will have no land generating rent to live on. You will have no business generating cash flow. You will be forced to sell your stocks at the bottom to pay your bills. That is how 70% of wealth disappears by the second generation. That is how your grandchildren inherit nothing. So what do you do? How do you rebalance from 90% liquid to 33, 33, 33 without destroying your net worth? Here is the protocol. You are not safely diversified as your financial advisor told you. You are concentrated in one asset class. This is not a small problem. This is the primary reason Christian families lose generational wealth. Your financial advisor keeps you 100% liquid because that adds what they can manage and earn fees on. They cannot charge you 1% annually to manage a rental property you own or a business you operate. They can only earn fees on liquid assets. Stocks, bonds, mutual funds. This is not malice. This is incentive alignment. Their business model requires your concentration in liquid. When you rebalance to 33, 33, 33, you will likely need to sell some of your 401k or IRA holdings to buy land or business equity. This feels wrong because you have been taught. Never touch your retirement account. But Jewish law says your retirement account being 90% of your net worth is the problem. A retirement account is a liquid bucket. It must be 1/3, not 9/10. Proverbs chapter 13, verse 22 says, "A good person leaves an inheritance for their children's children." Not their children, their children's children, your grandchildren. If you maintain 90% liquid, your children will inherit a reduced portfolio after the next crash. And your grandchildren will inherit nearly nothing. You are not being a good person in the biblical definition if you do not rebalance to preserve generational wealth. Now let me show you the historical proof that 33, 33, 33 works in crisis. Two families in New York. Same neighborhood, same income level, same net worth, 100,000, a fortune in 1929. Mr. Cohen, Jewish immigrant, follows the Talmudic 33-33 allocation. Mr. Smith, Christian banker, follows modern advice, 100% stocks. Cohen's allocation before the crash. Land, 33%, 33,000 in 3 rental properties in Brooklyn. Generates $200 per month rent. Business, 33%, 33,000 silent partnership in a grocery store. Generates $150 per month cash distribution. Liquid 33%, 34,000 in stocks and cash. Smith's allocation before the crash. Liquid 100%, 100,000 in blue chip stocks. U.S. Steel. General Electric, RCA, the safe stocks of 1929. October 1929, the crash hits. The stock market loses 89% by 1932. Cohen's situation in 1932. Liquid bucket, his 34,000 in stocks is now worth 3,700, an 89% loss painful. Land bucket, his rental property's market value dropped 50% to 16,500. But tenants still pay rent, reduced to 120 per month due to the depression, but cash flow continues. Business bucket, grocery store income reduced. People buy less, but cash flow continues at 80 per month. Total net worth, about 54,000, a 46% loss from the original 100,000. Severe damage, but not destroyed. Monthly cash flow, 120 rent plus 80 business equals 200 per month. He can survive without selling stocks at the bottom. Cohen's actions from 1932 to 1935. He uses his remaining 3C700 liquid to buy land from desperate sellers at 15 to 20 cents on the dollar. He buys 2 more rental properties for 8,000 total. They would have cost 40,000 in 1928. 1940s recovery. His land portfolio is now worth 200,000. His business survived and expanded. Total net worth, 350,000. 1960, Cohen dies. His children inherit an intact 3-bucket system. His grandchildren today still own some of the Brooklyn properties bought in 1932. Generational wealth preserved. Smith's situation in 1932. Liquid bucket, his 100,000 in stocks is now worth 11,000, an 89% loss. Land bucket, 0, no rental income. Business bucket, 0, no business cash flow. Total net worth, 11,000. Monthly cash flow, 0. He must sell remaining stocks to buy food and pay rent. 1932, forced to sell remaining stocks at the bottom to survive. He takes a job as a bank clerk. 1940s, the stock market recovers, but he owns no stocks. He sold them all at the bottom in 1932. 1950, Smith dies with a 3,000 estate. His children inherit almost nothing. His grandchildren do not know his name. Generational wealth destroyed in 36 months. 2008, same pattern. Those with land plus business plus liquid survived and bought bargains. Those 100% in stocks and portfolios lost 40 to 60% and panic sold. 2020, COVID crash, same pattern repeated again. The 33-33-33 ratio has never failed in 3,000 years. Not once. Let me ask you directly, if 1929 happened today, would your current allocation look like Cohen's or Smith's? Would you survive, or would you be destroyed? That is not a theoretical question. That is a diagnostic. Now here is exactly how you rebalance to 33-33-33 over the next 5 years. Step 1. Measure your current allocation. Calculate your total net worth. Add up all liquid assets, 401k, IRA, savings, stocks, bonds, plus all land. Home equity, rental properties, plus all business, ownership stakes in operating companies. That is your total net worth. Now divide each category by the total to get percentages. Most of you will find 85 to 95% liquid, 5 to 15% land, 0% business. Step 2. Identify deficient buckets. Compare your percentages to the biblical standard. 33% land, 33% business, 33% liquid. Which buckets are below 33%? For most of you, land is 20 to 25 points deficient. Business is 30 to 33 points deficient. Those are the buckets you must build over the next 5 years. Step 3. Create a 5-year rebalancing plan. Do not sell 60% of your 401k tomorrow to buy rental properties and businesses. That would trigger massive taxes and destroy your net worth. Instead, gradual rebalancing. Year 1, direct all new savings, money you earn this year, to deficient buckets. If you save 20,000 this year, put 10,000 toward land, down payment on a rental property, 10,000 toward business, silent partnership, or crowdfunding equity. Years 2 through 5. Continue directing new savings to deficient buckets. Each year, rebalance by selling small portions of your over-concentrated bucket, your liquid 401k, to fund under-allocated buckets. Spread sales over 5 years to minimize tax impact. Step 4. How to build the land bucket if you lack capital. House hacking, buy a duplex, live in one unit, rent the other. Rent covers the mortgage. Farmland crowdfunding, platforms like AcreTrader allow 5,000 minimum investment in farmland. REIT allocation, real estate investment trusts. Partial credit because they trade like stocks, so they are partially liquid, but invest in land. Partnership, partner with family or friends to buy rental property together. You own 25%, they own 75%. It still counts toward your land bucket percentage. Step 5. How to build the business bucket if you have no business experience. Silent partnership, invest in a friend's or family member's operating business as a silent partner. You contribute capital, they operate, you receive a percentage of profits. Equity crowdfunding, platforms like Mainvest, Republic, Start Engine allow investment in small businesses. Minimum 100 to 1,000. You own equity in operating companies generating revenue. Buy an existing small business. Many retiring owners will sell with seller financing. You pay over time from the business's cash flow, no bank loan needed. Royalty agreements, invest in intellectual property, music royalties, patent licensing. That generates ongoing cash flow. Step 6. Annual rebalancing maintenance. Every year on January 1st, recalculate your percentages. If one bucket has grown above 36% or shrunk below 30%, rebalance by selling from the overweighted bucket and buying into the underweighted bucket. Maintain 33, 33, 33 with plus or minus 3% tolerance. Common obstacles. I am 95% liquid in my 401k. Will not selling trigger taxes? Yes, but gradual sales over 5 years, plus Roth conversions, plus tax loss harvesting, minimize the impact. The tax cost is less than the risk cost of staying 95% liquid. I am 90% in my house. Should I sell it? No. Stop adding to the land bucket. Direct all new savings to business, plus liquid, until balanced. I have no business experience. I will fail. Silent partnership or crowdfunding equity means you do not operate the business, you own it. Others run it. This is not just financial rebalancing. This is generational responsibility. Here is what is at stake. The allocation decision you make today determines what your grandchildren inherit in 50 years. If you maintain 90% liquid, the next market crash reduces your net worth by 40 to 60%. Your children inherit the reduced portfolio. They make the same mistake, staying 90% liquid, because that is what you taught them. The next crash hits them. Your grandchildren inherit 10 to 20% of what you started with. This is not theory. This is statistical reality. 70% of wealthy families lose their wealth by the second generation. 90% lose it by the third generation. The primary cause is not bad investments. It is lack of systematic allocation. Heirs concentrate wealth in the hot asset of their era. Stocks in the 1920s, real estate in the 2000s, crypto in the 2020s, and crashes destroy them. Proverbs chapter 13 verse 22 says, "A good person leaves an inheritance for their children's children, but a sinner's wealth is stored up for the righteous." Notice the time frame, not your children, your children's children, your grandchildren. A good person builds generational wealth. A sinner, one who misses the mark of God's design, builds personal wealth that does not survive 2 generations. The 33-33-33 allocation is how you become a good person in the biblical definition. If you rebalance to 33-33-33 today and teach your children to maintain it, and they teach their children 100 years from now, your great-great-grandchildren will own land that appreciated for a century, businesses that generated cash flow for a century, and liquid that bought bargains during 5 or 6 crashes. They will know your name. They will call you blessed. That is biblical legacy. What will your grandchildren inherit? A broken portfolio that crashes every decade, or a balanced 3-bucket system that survives every crisis for the next 100 years? That choice is made today, not tomorrow, today. Here is what you must do. You have learned today that wealth preservation requires 3 buckets in equal portions. Land, which cannot be inflated away. Business, which generates cash flow. Liquid, which captures opportunities. Exactly 33% in each. Not 40-40-20, not 30-50-20. Exactly 33-33-33. This is the biblical allocation system that has survived every economic collapse for 3,000 years. This is what King Solomon encoded in Ecclesiastes chapter 11. This is what Jewish law codified in the Talmud. This is what separates Jewish families who preserve wealth for 100 years from Christian families who lose 70% by the 2nd generation. Before we pray, I need you to do something important. Subscribe to this channel right now. Click the button below this video. More of Solomon's ancient wealth wisdom is being released every week. The next video will teach you how to protect your 3 buckets from lawsuits, seizure, and government confiscation using structures Jewish families have used for centuries. You do not want to miss that. Subscribe now, then return here. Now close your eyes if you can. Or if you are driving or walking, simply align your thoughts with mine. What we are about to speak is not formula. It is alignment with biblical design. Father, we come before you as stewards of the wealth you have entrusted to us. We confess that we have allocated foolishly. We have concentrated 90% of our wealth in 1 bucket, believing modern advice over ancient wisdom. We have called it diversification when it was concentration. We have gambled with our children's inheritance. Give us the courage to measure our allocation honestly today. Give us the wisdom to see that stocks, bonds, and savings are the same category, liquid. Give us the discipline to rebalance systematically over the next 5 years to reach 33% land, 33% business, 33% liquid, where we lack capital to buy land or invest in business, open doors of partnership and opportunity, where we fear the tax consequences of selling liquid assets. Provide creative solutions through Roth conversions and tax loss harvesting, where we doubt this 3,000-year-old system. Remind us of Cohen, who survived the Great Depression, and Smith, who was destroyed. We trust that as we obey Ecclesiastes 11:2 and divide our portion among 3 categories, you will multiply what we steward faithfully. Protect our land from inflation. Bless our businesses with cash flow. Position our liquid assets to buy bargains when the next crash creates opportunity. Let our grandchildren's grandchildren praise you for the inheritance we leave, built on biblical allocation, not modern guessing, in the name of Jesus Christ. Amen. You are not trapped in your current allocation. You are free to rebalance. You are now equipped with the system that has preserved wealth for 3,000 years. Go and build with precision.